I just spent 1.04 million Czech crowns on a single share that most investors don't want today, and I'll show you why that's a mistake and why I expect it to double in value within a few years. We'll talk about it at the end of the video. Let's look at US debt, because it's being discussed everywhere right now. Even a major investor in Liberon asked me last week if the US was on the verge of collapse. Let's take a look at Google, my largest position, which has already made me over 100% profit this year. And at the end, I'll show you a company I just invested over $1 million in. I'll tell you why and what my expectations are. Let's get started. There's a lot to cover today. Let's get started. Many people are very confused about what US debt actually means, who the US owes money to, and whether this poses a real risk for us as investors. Even a major client at Liberon Capital asked me about this last week when we were discussing the allocation of his portfolio. Let's make it really simple. The US currently owes over $38 trillion. That's a huge number. But 75% of that debt is held by Americans themselves, funds, banks, pension systems. Not some mysterious elite, as you sometimes see on TikTok. The largest holders are pension funds, that is, Americans' retirement money. Another 15% is held by the Fed, and the rest is held by foreign investors such as Japan and China. First important point, the US primarily owes itself, not to someone who could economically blackmail it. And now what investors are most interested in, is this debt a problem? Not in the short term. In the long term it may be, but not because the US will go bankrupt. That's nonsense. There are two problems. 1. How fast the debt is growing. 2. How fast the interest the US pays on it is growing. Americans already spend more on interest than on the military, and that's a huge change. When interest rates rise, bond yields rise, and so does the cost of capital for the entire economy. More expensive mortgages, more expensive loans, more expensive financing for businesses, slower economy, lower stock valuations. This is what you as an investor need to watch, not the amount of debt itself. Just type 10-year yield bond into Google and you'll see the number that determines market valuations today. When yields rise, tech stocks come under pressure. When yields fall, stocks have room to grow. It's simple macroeconomics, but extremely effective. And now for one important conclusion, the US isn't perfect, but it's still the best financial market in the world. Developed, liquid, transparent. And for long-term investors, it's still the best option we have today. Definitely better than Europe or most of Asia. By the way, before we look at Google, I'll tell you one thing that can save you a lot of money. What we discuss here in the videos is only a small part of what I actually do in my portfolio. Bond yields, valuations, position adjustments, real purchases. I share all of this in real time only with my investment community on Patreon. There you'll find not only my opinion, but also investment journals from senior analysts so you can get more professional insights. There are already over 6,000 investors there, and if you want to see my real purchases for 2026 exact prices and my investment models, it will save you several years of trial and error. That's why there are also educational videos for beginners. The link is below the video. Now let's move on to Alphabet, because it made me over 125% profit this year, and many of you are wondering whether to sell or hold on to it. And one of the best and also largest companies is Google, if we look at Monero. I currently have 232 Google shares with an average purchase price of $142 per share. My position is roughly 125% in profit, and you are in a similar situation, at least according to what I have been receiving in messages on Instagram. In recent months alone, Google is up by tens of percent, and many of you are asking, should I sell, buy, or hold? Here's my opinion. Alphabet reported its results a few weeks ago, and in my opinion, those results perfectly demonstrated what a modern technological profit machine should look like. And now, one thing that most investors overlook. Google has a unique combination of high profitability and a huge reinvestment runway. Search generates such massive cash flow that it finances all of their AI ambitions in the cloud. This means that Google doesn't have to choose between growth and profit. It can do both. And that's a very strong position for a long-term investor. When I evaluate Google, I look at three things: margins in Google Cloud, the pace of revenue growth in search, and CapEx efficiency. As long as these three metrics hold, there is no reason to worry about short-term price movements in a company like Alphabet. This is a company that compounds value. We bought it in the community for under $150. Some bought it for $140, some even for $130. These are prices that come around once every few years. I personally hold Google because my average is $142. With that average, it makes no sense for me to sell. I don't need to catch the peak. I'm watching two things: the development of its capex and margins in the cloud. If capex grew by 40 to 50% for 2 to 3 years in a row and margins in the cloud stagnated or declined, that would be the first red flag. But that's not happening right now. Google is the type of company where I don't sell profits, but only sell when the fundamentals change. It's a simple rule. Now let's move on to the mysterious company that I bought and which I personally expect to double in value within 2 to 4 years. It's a company whose fundamentals are growing nicely. By that I mean sales and profits, but the share price has been stagnating for years. It's PayPal, ticker symbol PayPL. Overall, I now have 766 shares with a purchase price of $65.69 per share, so I'm now slightly in the red on it. I already had a small position in PayPal in the past, but now we've expanded it by about 550 shares. And now I'll tell you the most important thing. I'll tell you why. Look at this chart. The purple line is the share price, which you can see has been stagnating since 2021 after a sharp decline, and the charts behind it show the operating profit of the company. So you can clearly see how the company's profits are growing while the share price is stagnating. PayPal is really cheap today, but why? Everything has its reasons. Probably the biggest one right now is that there is a general fear of weak consumer spending, i.e., a fear that Americans will spend less, which will of course affect the number of payments, transfers, etc. If you are a company that lives off various transactions, this will affect you. There is certainly temporary uncertainty here. And investor sentiment is not good. The latest earnings call didn't help either, as managers were rather cautious and did not get investors excited about a positive future. However, the big players in the market, i.e., institutions, are slowly buying PayPal. If we look at this chart, we can see that the green columns represent purchases by big players and funds, and the red ones, which are smaller, represent sales, which of course is what you want to see as a shareholder. You want to see that the big boys are buying your stock rather than selling it. PayPal is currently valued as a second-tier company, but its business parameters do not fully correspond to this. By the way, XTB still offers a buy one share, get one free promotion for newly registered users. All you have to do is register, buy your first share, and you'll get a free share. However, the promotion is only for newly registered users. Enter the referral code OK when registering, so if you want to get started, you'll get something in return, which isn't bad. I've put the link below. We are talking about a global payment network with revenues of over $30 billion a year and hundreds of millions of active users. The company generates solid profits. Analysts expect EPS growth of around 10 to 15% per year, and the stock is trading at around 12 PE, i.e., earnings. This is significantly below the market and below competitors such as Visa, MasterCard, and Block. Add to that a relatively strong balance sheet, a newly introduced dividend, and a buyback program worth nearly $20 billion, roughly one-third of market capitalization. Management is clearly saying that it considers the current price to be undervalued. The negatives are clear: fierce competition in payments, a possible economic slowdown, the regulatory environment, and pressure on margins. But in my opinion, these risks are already largely factored into the price. The market is focused on the past and the disappointments of recent years, not the potential of the network, brand, and cash flow in the years to come. That's why I personally see PayPal today as a more conservative value position within fintech, and I see an asymmetry between how much it can still fall versus how much it can shoot up in the next 2 to 4 years. That's why I'm building PayPal as my next big position in my entire portfolio. If you want to see my actual purchases and the prices at which I will be increasing my technology and other stocks during 2026, I am posting this in real time only on Patreon. And honestly, now is the most important period in recent years. Bond yields, tech valuations, and consumer sentiment will determine who will earn money over the next 3 years and who will not. More than 6,000 investors have access to all my videos, portfolio analyses, and the first educational program that will teach you how to build a profitable portfolio from scratch. Take care.